When most people think about debt, they imagine something to avoid, a financial burden that can lead to stress and even ruin. However, the wealthy often see debt differently. They use it as a tool to build more wealth and generate income. This strategic use of debt is a common practice among the rich and plays a significant role in how they manage their finances. Here are some key strategies the wealthy use to leverage debt effectively. Number 1. Understanding good debt versus bad debt. Before diving into the strategies, it's important to understand the difference between good debt and bad debt. Good debt is debt that is used to acquire assets that generate income or appreciate in value. Examples include mortgages for rental properties or business loans. Bad debt, on the other hand, is used to purchase items that depreciate in value and do not generate income, such as credit card debt used for vacations or expensive gadgets. Number 2. Mortgages for real estate investments. One of the most common ways the wealthy use debt is by taking out mortgages to invest in real estate. Real estate can be a lucrative investment because it appreciates over time and can generate rental income. By using a mortgage, the wealthy can purchase properties without tying up all their capital. By putting down a fraction of the property's value, say 20%, and borrowing the rest, they can control a much larger asset. For example, with $100,000, they can buy a $500,000 property by borrowing $400,000. This leverage allows them to benefit from the appreciation of the entire property's value, not just their initial investment. The rental income from the property can cover the mortgage payments, property taxes, and maintenance costs. Over time, as the mortgage is paid down, they build equity in the property while also enjoying potential appreciation in its value. Mortgage interest and property taxes are often tax-deductible, reducing their taxable income and further enhancing their returns. Number 3. Business loans for expansion. Another way the wealthy use debt is by taking out loans to expand their businesses. This can include everything from opening new locations to investing in new equipment or technology. By borrowing money to invest in business growth, they can increase their revenues and profits. For example, a business might take out a loan to open a new store, which can bring in additional income and attract more customers to the existing stores. Taking on debt allows business owners to expand without giving up equity. This means they retain full ownership and control of their business while still benefiting from its growth. Interest payments on business loans are typically tax-deductible, which reduces the overall cost of borrowing and improves profitability. Number 4. Margin loans for investing in stocks. The wealthy often use margin loans to invest in the stock market. A margin loan allows an investor to borrow money to buy more stocks than they could with just their own capital. By using margin, investors can amplify their purchasing power. For example, if they have $100,000 in cash, they might be able to borrow another $100,000 to buy $200,000 worth of stocks. This allows them to potentially double their returns if the stocks go up in value. Margin loans often come with relatively low interest rates, making them an attractive option for wealthy investors who can afford to take on more risk. By borrowing money to invest, they can diversify their portfolio more extensively, spreading risk and potentially increasing returns over a broader range of investments. Number 5. Using home equity loans. Home equity loans or lines of credit, HELOCs, are another popular tool among the wealthy. These loans allow homeowners to borrow against the equity in their home, which can then be used for various investments. Home equity loans often come with lower interest rates compared to other types of loans, making them a cost-effective way to access capital. The funds from a home equity loan can be used to invest in other properties, start a business, or invest in stocks. This can potentially generate higher returns than the interest rate on the loan. Interest paid on home equity loans may be tax-deductible if the funds are used for home improvements, providing an additional financial benefit. Number 6. Leveraging credit lines. The wealthy also use lines of credit to manage cash flow and finance investments. A line of credit is a flexible loan that allows borrowers to draw funds as needed, up to a certain limit. A line of credit offers flexibility to borrow and repay funds as needed. This can be especially useful for managing business expenses or taking advantage of investment opportunities as they arise. Interest is only paid on the amount borrowed, not the entire credit limit. This makes lines of credit a cost-efficient way to access funds. By using a line of credit, the wealthy can keep their cash reserves intact while still having access to funds for investments or emergencies. Number 7. Leveraged buyouts. In the corporate world, leveraged buyouts, LBOs, are a common strategy used by the wealthy to acquire companies. In an LBO, a significant portion of the purchase price is financed through debt, with the acquired company's assets often used as collateral. If the acquired company performs well, the returns on the initial investment can be substantial because the buyer controls a much larger asset base with a relatively small amount of equity. Interest payments on the debt used in an LBO are tax-deductible, reducing the overall cost of the acquisition. Leveraged buyouts allow investors to gain control of a company without having to provide all the capital up front. This can lead to significant influence over the company's operations and future direction. Number 8. Using personal loans for strategic investments. Personal loans, while often viewed as risky, can be used strategically by the wealthy to finance investments that offer higher returns. Personal loans can provide quick access to capital for time-sensitive investment opportunities, such as buying a property at a discount or investing in a promising startup. If the interest rate on the personal loan is lower than the expected return on the investment, the wealthy can benefit from the difference, effectively earning a profit from the borrowed funds. Some wealthy individuals use personal loans to consolidate higher interest debts, reducing their overall interest expenses and improving their financial position. Number 9. Private equity and venture capital. The wealthy often invest in private equity and venture capital, which involves funding startups and private companies in exchange for equity. By using borrowed funds to invest in private equity or venture capital, the wealthy can increase their investment capacity and potential returns. These investments can yield significant returns if the funded companies grow rapidly or go public. Investing in a range of startups and private companies helps diversify their investment portfolio, spreading risk and increasing the chances of high returns. The wealthy use debt strategically to build wealth and generate income. They understand the difference between good debt and bad debt, and they leverage debt to invest in assets that appreciate or generate income. Whether it's through real estate investments, business expansion, stock market investments, home equity loans, or private equity, the rich use debt as a tool to enhance their financial position. By adopting some of these strategies and being mindful of how debt is used, anyone can take steps toward building wealth and achieving financial success. The key is to use debt responsibly, ensuring that the returns on investments outweigh the costs of borrowing, and to maintain a balanced approach to managing debt and assets.